Hey guys, we're continuing the steps to home ownership. In the previous video, we talked about the first thing that you need. Seems like common sense, but not always the case. Hey, that's what I'm here for. It was income. In this topic, we are going to talk about item number 2, and probably the topic that drives Kurt crazy, and I gotta admit myself as well. But I have a little bit more patience with it just because I know they don't teach you this in high school, sometimes not even in college if you don't take a specific course for it. But number 2 is a doozy and probably the top, even over income, questions we get, and it's called credit, the dreaded C word, but it doesn't have to be your dreaded C word. It really could be your power position. It really can be. And you just need a little education on, what you need to do. Just again, when I'm talking about this topic, just like I did in income, there's going to be very specific questions you have for a lender. And I'm not going to be able to tell you your credit score. Ironically, Credit Karma is not going to be able to tell you your credit score because lenders use a different algorithm when they're looking at your credit score. I've had clients say, oh gosh, I don't know if I'm there yet. Credit Karma is showing me 640. And I say, hey, listen, you have to know where you are to know where you need to go or where you currently are, right? They'll get their credit run. They have a 740 credit score from the lender. And they are ready to go. They have all the other elements that we'll talk about. Then there's other people that say, my Credit Karma says 740. And they pull it and it's a 640. So people go crazy, like how can these numbers be? Where do they get these numbers from? What can I do to improve my credit score? The one lesson, and I talk about this and why we take such great pride in this education with GreatHomesATL and what we're about, is because we've lived it. We're not only real estate brokers and agents with our own brokerage firm, like that competes with everybody out there. We still remember that feeling of actually getting rejected for a mortgage loan because of our credit. So we speak from experience as potential home buyers ourselves at one point in our lives, in our career. And there's a lot of factors. We've lived it with you guys. We've had car notes, or we've had car notes. We had student loans, or we have student loans. We have been laid off. We've had IRS debt. We've had medical bills. We've had down to our last, $1,000 to our account and had to take priorities over other things. Like, we lived it. So this is what I want to share with you from experience, because I and Kurt have gone through it all. And we're not going to have all the answers, but we're going to tell you from our experience and just our general rule of thumb that might be able to help you. But again, the only person that can tell you your true credit score, your true credit score, is a lender. And we recommend you DMing us when you think you're ready, when you've watched all these videos back and all the things that you need to start the process to go for your pre-approval, and when you feel like you're ready. But my biggest advice over all this is to know where you are, to know where you have to go, if you have to go anywhere, because you might be okay where you are. So that'd be my number one advice. Reach out to a mortgage lender, preferably one of ours, just because we like to kind of help you and guide you through that process. And we have great relationships with them. But general rule of thumb with credit scores. In general, a 580 or higher can technically qualify you. But the higher your credit score, the lower the interest rate you're going to get. It's going to be reflective because of various factors. So let's get into it. And I hear from a lot of people, I'm scared. I don't want to open a credit card. I'm scared to open a credit card. Number one, if you are trying to buy a home without having gotten a credit card, you've been living in fear, right? So what makes you think you're going to take on this huge obligation, right, of paying back 150, 400, 500, 800, whatever the price point may be, without having had some experience showing yourself that you can pay bills and pay them on time? So my first advice would be not having any credit is just as bad as having bad credit. What do I mean by that? If you have never had a car in your name, if you've never had a credit card in your name, if you haven't paid back a student loan, and you just have no credit history, that's just as bad as having bad credit, because you have not proven yourself to a mortgage lender that you can be responsible and pay things on time. So rule number one is use credit. Number two, the biggest factor of them all when it comes to your credit score is paying bills, paying them on time. If your statement says September 15th, my American Express is due, my student loan is due, my car note is due, pay it. Pay it on time, pay it in advance, pay it if you want, if you can, even before the statement is printed to affect your debt levels. Pay it, just pay it when you have the money. And if you are like paycheck to paycheck having to pay those bills, that's another sign that you're probably not ready, honestly, to become a homeowner, because it's a huge responsibility. It's going to be, above all your other bills, the most important bill. You can live off of peanut butter and jelly sandwiches, ramen noodles, smoothies, water and bread. If you had to, then you'd rather do that than not have a roof over your head or to jack up your credit for many years. So this is all set. You have to look at it as this credit profile is preparing you for this moment. The next thing, credit limits. That means if American Express, if Visa, if MasterCard gives you a $1,000 credit limit and you don't use it, and that's the only card that you own, that's the only piece of credit that you have a credit line of $1,000. Well, what if you had 4 or 5 credit lines? And some of them were 2,000, some of them were 5,000, some of them were 500, whatever the case may be. You would add all those up, and that is what your credit, I would say your credit value, your credit equity would be. Like, I know that I myself always check in now on what my credit limits are. And it's super important, because I could sit back and say, between my credit limit and my credit usage, I actually have equity, credit equity of, at times, $30,000, $80,000, $100,000. Doesn't mean I have to use it all, nor should I use it all. But there's a power in having accessible credit, because life will throw you curveballs. Layoffs happen. Getting fired sometimes happens. Health issues happen. A death in the family happens. So you have to have, your power is not just in cash. Cash is powerful, but even more powerful is this credit equity. Say it after me. Credit equity. What is the difference between your credit levels and your credit usage? So again, let's just say you have 3 or 4 cars and they value $10,000, and you start using them and you're paying them on time. The next thing you have to look out for is keeping that usage ratio at a minimum under 30%. That's when you're going to see credit scores slightly going up, stabilizing, and not dipping. The things that cause it to dip in this scenario is if I have $10,000 of credit available to me, credit line, and I use 10,000, I'm using 100%. What does that look like? What does that look like to a creditor? That means you are maxed out. That means most likely you do not have $10,000 to your name, or else you would just wipe that out, right? So the more credit usage that you use compared to your credit line is a very, very big factor. So no more than 30%. It gets better at 20% and under. It gets really good at 10% and under. And if you use, 1%, 2%, 5% and continuously keep that low, you're going to, trust me, if you've done paying bills on time, utilizing this credit, you are more than likely going to have scores high sixes, well into the sevens, and possibly even in the eights. Now, what are the other factors? The age of your credit. If you are, you got your first credit card out of college and you've only owned it or, had it for 6 months, that's not a great credit history. But think of how powerful that is when MasterCard, Visa, American Express, your student loans, your car notes, those things are paid off or paid down or paid on time over 2 years, 4 years, 7 years, 10 years. You could understand why your purchasing power for your second, third, fourth, fifth investment properties, land, all those things, your credit becomes more and more valuable because chances are, you're making more money as you go along. You continue to pay things on time. Maybe you're now in a relationship. Maybe you have children. Maybe all these factors are coming into play, and it's showing year after year after year that you are paying things on time and utilizing your credit ratios to a T. Finally, so those are just literally the biggest factors: paying on time, opening credit, not having no credit, right? And your credit utilization and the age of your credit. Those are really the top 4 factors of your credit score. Now I'm gonna end this video with just, again, general rules of thumb as far as areas to shoot for. So typically lenders look at around 580 to 620. They're not looked at as the most favorable. You may qualify depending on other factors, which we'll get into, but chances are you're gonna pay a much higher interest rate, and your mortgage is going to be looked at in underwriting much more strict, much more having to answer a lot of questions. 620 to 660, you're getting much better. You're probably getting a relatively decent credit score. I would say 660 to about 680. You're really strong potentially in conventional, but more so in that FHA, as long as your ratios are looking good, which we'll get into as well. 680 or higher opens up the door to a lot. Some of the best interest rates, conventional mortgages, lower interest rates. And I would say after that, the range would be 720 to 740. Same scenario, just even better interest rates. And 740 to 850 is the creme de la creme. That means if your credit score is 740, if it's 745, 800, it doesn't matter. Anything 740 or higher in a mortgage company is looked at as you are A1 credit, A+++++ credit. So hopefully that, guys, gives you a good general rule of thumb. We'll go on to the next topic, continue to watch these videos and get educated. All right, I'll talk to you soon.